While Americans were enjoying the Martin Luther King Jr. holiday yesterday, the global financial system quietly began to collapse. Over 48 hours, trillions of dollars in wealth vanished from European and Asian markets. The reason? The United States just launched an economic war against its own allies over an island covered in ice. January 20th, 2026, U.S. markets opened to chaos. And by the end of this video, I will show you the leaked $108 billion hit list Europe is preparing to obliterate American businesses, and why smart money is dumping Bitcoin to buy record-breaking gold. This is the Black Tuesday market meltdown. While you were off work Monday, futures markets were bleeding. Traders watched in horror as S&P 500 futures dropped 0.9% and Nasdaq futures collapsed 1.1%. The world was pricing in a Dow Jones opening loss of 367 points. But here's what actually happened when the bell rang this morning. The S&P 500 clawed back to 6879 points, up a microscopic 0.01%. Don't let that fool you. This isn't stability. This is a dead cat bounce on a tightrope, because while U.S. markets were closed, Europe was getting massacred. Germany's DAX plunged 1.3%. France's CAC 40 dropped 1.5%. And the carnage in individual stocks? BMW crashed 3.7%. LVMH, the luxury giant, plunged 4.7%. By Tuesday, Germany's DAX opened down another 0.8%. with BMW collapsing an additional 3.5%. This isn't a correction. This is a rout. And here's why American investors should be terrified. Apple makes 25% of its revenue in Europe. Tesla sources critical components globally and faced 5 to 10% cost increases per vehicle during previous tariff wars. When Europe retaliates, and they will, your tech stocks are in the blast radius. Remember April 2025 when Trump announced reciprocal tariffs? Apple dropped over 6% in after-hours trading. Nvidia fell 4%. Tesla declined 4.5%. That was a warning shot. This is the real war. Now let me show you the weapon Europe is loading. The European Union has prepared a €93 billion, that's $108 billion, retaliation package targeting American goods. This isn't a negotiation tactic. This is a loaded gun pointed at the heart of Trump country. The hit list includes bourbon whiskey from Kentucky, Harley-Davidson motorcycles, and blue jeans. Notice something? These aren't random products. Bourbon targets Senate Majority Leader Mitch McConnell's home state. Orange juice hits Florida, a swing state Trump needs. Soybeans devastate Republican-leaning agricultural states across the Midwest. Brussels didn't just pick these products for economic impact. They picked them for political warfare. They want American farmers, factory workers, and Main Street businesses screaming at their congressmen to stop the madness. But that's just the conventional weapon. Europe has a nuclear option. French President Emmanuel Macron has formally requested activation of the Anti-Coercion Instrument, or ACI. This trade bazooka allows the EU to impose tariffs, restrict or ban U.S. firms from accessing the EU single market of 450 million consumers, and bar American companies from bidding on public contracts. Can France really ban U.S. tech companies from Europe? Yes. The ACI explicitly empowers the EU to restrict access to parts of the single market. We're talking about Google, Meta, Amazon Web Services, Microsoft Azure. American tech giants who benefit from a services trade surplus with Europe are now prime targets. Here's what's more likely than outright bans. Discriminatory taxation on U.S. tech revenue. Data localization requirements forcing companies to build expensive European data centers. Aggressive antitrust enforcement and privacy investigations designed to bleed these companies dry. Public procurement exclusions blocking U.S. firms from lucrative government contracts. And Macron isn't bluffing. He called Trump's tariff threat unacceptable and is rallying European leaders to pull the trigger. If activated, this would be the first time the ACI has been used since its creation in 2023. Europe has scheduled an emergency summit in Brussels this Thursday, January 23rd. The timing is calculated. It happens one day after Trump speaks at the World Economic Forum in Davos tomorrow. They want to hear what Trump says, then decide whether to launch the $108 billion counterstrike. Now, here's where it gets really interesting. While stocks were crashing, One asset hit an all-time record. Gold reached $46.89.15 per ounce yesterday. That's not a typo. $46.89, an all-time high. Gold has posted more than 50 new record highs in 2025 alone and delivered a yearly return exceeding 60%. Why are central banks panic buying gold right now? Because the world is de-dollarizing in real time. Global central banks added over 1,000 metric tons of gold to reserves in 2024. That's the third consecutive year purchases exceeded 1,000 tons, more than double the long-term average. Poland, China, India, and Turkey are leading the charge, reducing reliance on the US dollar and diversifying reserves. When interest rates fall, gold becomes more attractive because it doesn't pay dividends. With the Federal Reserve expected to cut rates in 2026 due to recession fears, the opportunity cost of holding gold drops to zero. Add geopolitical chaos, and you get a perfect storm for gold prices. But here's the asset that was supposed to replace gold, the so-called digital gold, Bitcoin. Bitcoin crashed 3% to $92,500 while gold soared. The digital gold narrative just failed its biggest stress test. In 4 hours Monday, more than $750 million in Bitcoin long positions were liquidated. Total 24-hour liquidations exceeded $860 million. The broader crypto market shed over $100 billion in value, falling from $3.24 trillion to $3.13 trillion. Why did Bitcoin collapse while gold rallied? Liquidity crisis. With U.S. equity markets closed Monday and European investors rotating into traditional safe havens, Bitcoin lacked sufficient buyers to absorb selling pressure. Aggressive leverage in derivatives markets created cascading liquidations in a thin liquidity environment. Despite 15 years of marketing, institutional investors still treat Bitcoin as a risk-on asset correlated with tech stocks, not a safe haven. During true geopolitical stress, when the stability of Western alliances faces existential questions, investors revert to 5,000-year-old monetary traditions, not 15-year-old cryptographic experiments. Even silver outperformed Bitcoin. Silver climbed above $93 per ounce, gaining over 15% for the week. Silver benefits from both safe haven demand and industrial applications in solar panels and electric vehicles. Bitcoin, it's just code on a server. Now, let's talk about the Asian contagion spreading across the Pacific. Japanese Prime Minister Sanai Takaichi announced Monday she will dissolve parliament Friday and call a snap election for February 8, 2026. She's gambling everything on a promise to halt the 8% consumption tax on food for 2 years, a measure that would cost $32 billion annually in lost revenue. Japanese bond markets are calling her bluff. The yield on Japan's 10-year government bonds hit a 27-year high, briefly reaching 2.27%, the highest level since February 1999. By Tuesday, yields rose further to 2.35%. Why does this matter? Japan's gross government debt already exceeds 260% of GDP, the highest among major developed economies. Adding $64 billion in lost revenue over 2 years while increasing defense spending creates fiscal arithmetic that bond investors find untenable. If Takaichi wins, her aggressive fiscal expansion could force the Bank of Japan into premature rate hikes to control inflation and stabilize the yen, ultimately tightening financial conditions and undermining her growth strategy. It's a fiscal death spiral in slow motion. And Trump's Greenland tariffs prove he's willing to weaponize trade against any ally. Last week, China banned exports to Japan's military of items with dual civilian and military uses, including critical minerals. Japan is getting crushed between U.S.-China decoupling. Meanwhile, China reported fourth quarter 2025 GDP growth of 4.5%, meeting its official 5% annual target. But that headline number hides catastrophic structural weakness. Retail sales grew just 0.9% in December, the lowest level since 2022. That figure declined every month from May through year-end. China's Statistics Bureau chief admitted that the contradiction between strong supply and weak demand is pronounced. The property sector collapsed. China recorded a fall of 17.2% in property investment in 2025. Overall fixed asset investments, including infrastructure and manufacturing, fell 3.8%, marking their first annual contraction in almost 3 decades. China is running a two-speed economy. Exports and manufacturing are strong. Exports grew 5.5% annually. Industrial production reached 5.9%. China's trade surplus hit a record $1.19 trillion in 2025. But consumption is dead. Retail sales logged just 3.7% growth. Urban consumption, 86% of the national total, grew only 3.6%. Is China vulnerable to this trade war? Or are they laughing as the West tears itself apart? Both. China's export-led model makes it sensitive to Western tariffs. But as the Atlantic Alliance fractures, European desperation for alternative markets creates massive opportunities. China recently opened its markets to Spanish and Irish companies following visits from their leaders. Macron is reportedly planning to invite Xi Jinping to a G7 summit in France this summer. If Germany, France, Japan, and South Korea lose industrial capabilities due to U.S. tariffs, achieving a supply chain free from Chinese components becomes nearly impossible. China's influence over supply chains is growing while America alienates its allies. Beijing is playing the long game. Now, tomorrow, Wednesday, January 22nd, Trump speaks at Davos, and all evidence suggests he will double down. Trump confirmed to NBC News Monday he would 100% follow through on the tariff threat. When asked if he would use military force to seize Greenland, Trump responded, "No comment." He told reporters in Florida, "We have to have it. They can't protect it." Denmark. A White House official indicated Trump's speech will emphasize that the United States and Europe must leave behind economic stagnation and reveal initiatives to drive down housing costs and tout his economic agenda. But analysts are bracing for chaos. The Atlantic Council warned, for all the Wall Street analysts who argued that the second year of Trump's term would bring more stability on the tariff front, Saturday morning should have been a wake-up call. Trump is not abandoning his favorite economic weapon anytime soon. This year's World Economic Forum theme is the spirit of dialogue. The irony is brutal. The WEF's own Global Risk report warned that the rules and institutions ensuring stability are now under threat in a new era where trade, finance, and technology are weaponized tools of influence. And Wall Street banks are sounding the alarm. JPMorgan has raised its global recession odds to 60% by the end of 2026, up from 40%. The bank stated that disruptive U.S. policies have been identified as the primary risk to the global outlook, with impact exacerbated by tariff retaliation, declining business sentiment, and supply chain disruptions. JPMorgan CEO Jamie Dimon warned in April 2025, "When you see a 2,000-point drop in the Dow Jones Industrial Average, it tends to feed on itself. It creates a feeling of losing money in your 401k and pension, leading to necessary cutbacks." Goldman Sachs elevated its U.S. recession probability to 35% over the next 12 months, up from 20%. Goldman revised its 2025 GDP growth forecast down to 1% and warned that higher tariffs are likely to exacerbate consumer crises, with increased prices diminishing inflation-adjusted income. This is stagflation, rising inflation combined with economic contraction, the Federal Reserve's worst nightmare. Moody's Analytics raised recession odds from 15 to 40%. Barclays expects U.S. GDP to contract in 2025, consistent with a recession. Citi cut its growth forecast to 0.1%. UBS reduced its forecast to 0.4%, warning that the forcefulness of trade policy action implies substantial macroeconomic adjustment for a $30 trillion economy. The consensus is clear. Major banks assign 35 to 60% recession probabilities to the U.S. and global economies in 2026. Here's what you need to understand. We are witnessing the end of the post-World War II alliance. The Atlantic is fracturing, and your 401k is on the battlefield. Europe is loading a $108 billion trade weapon aimed at American bourbon, motorcycles, and blue jeans to create maximum political pain in Republican states. France is pushing to ban or restrict U.S. tech giants from the European single market using a never-before-used nuclear option. Gold hit an all-time record as central banks de-dollarize. Bitcoin failed its digital gold stress test, crashing while gold soared. Japan's bond market is breaking under the weight of unsustainable fiscal promises. And Trump speaks tomorrow at Davos with zero indication he will back down. If Trump doubles down Wednesday, expect further safe haven flows into gold and silver, continued crypto weakness, and potential credit market stress. If he de-escalates, markets will rally hard. But don't count on it. Trump confirmed 100% commitment to these tariffs. The Supreme Court may rule as early as next week on whether to overturn Trump's tariffs. Denmark warned that any U.S. military actions in Greenland would jeopardize NATO's existence. We haven't seen anything like this in 80 years. Here's your action plan. Watch gold and silver charts closely. Prepare for higher inflation as tariffs hit consumer goods. Reduce exposure to companies with significant European revenue until this crisis resolves. And understand that the playbook from previous Trump trade wars no longer applies. NATO allies have never faced existential tariff threats from the United States. Subscribe to this channel to survive the 2026 trade war. We'll be covering every twist as Europe and America move closer to economic Armageddon. The game has changed. The stakes have never been higher. And the world is watching to see if the Transatlantic Alliance survives the week. Disclaimer: this is not financial advice. I'm not a financial advisor. Do your own research before making investment decisions.